Welcome to The Winning Trade. Each episode in this series will demonstrate how to make money in the stock market, whether the prices are going up, down, or sideways, using high probability, profitable strategies that were designed to take advantage of the volatility of the Russell 2000 and the S&P 500 indexes. Many of these strategies were designed to work together to maximize profits by flowing with the ever-changing market conditions. Follow along as we uncover the secrets of this episode's winning trade. Hello everyone, my name is John Locke and I'd like to welcome you to The Winning Trade. But first, the required disclaimer. Be aware that this presentation is given for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and make sure you are aware of all your risks prior to placing any trades. Also note that in the presentation, we will be showing hypothetical trades and/or results, and those results are believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many, many different reasons. Now, if this is your first experience with us, my name is John Locke. I'm a professional trading performance and success coach with Locke in Your Success LLC, and myself and my team are here to help traders win in the market and in life as well. And I'm here today to guide you into the realm of high probability trading. Now in a moment, not now, but in a moment, we'll be going over the winning trade. But before we do, let me quickly explain what we mean by an income or high probability trading strategy. An income strategy is where we put ourselves in a position to generate profits through the passage of time rather than solely depending on price movement to go in our direction. Meaning, we can often make money whether the price goes up, down, or sideways. Now, this doesn't mean we're going to win all the time, but it does mean that the probabilities of us winning are much, much higher than they might be otherwise. Now, when you find that you want more information as you're following along, simply contact us at lockeinyoursuccess.com or ask a question in the comments of this video, and that will allow us to direct you to where you can find more information. All right, so let's move on. The winning trade we're looking at today is an extremely simple strategy called the Super Bowl. Now, this is a strategy that I created as an example during one of our live 2-day events called the Trader Transformation Workshop in Orlando, Florida last January. And I created it in order to show our students how simple it can be to make money even during those really challenging periods like 2018. Now this strategy is going to be a little different than some of the other strategies we've presented in the past because it's not technically considered an income strategy. However, as you'll see, it certainly is a very high probability strategy. So the Super Bowl is a trade that we can do either on the SPX or the Russell 2000 indexes. It requires a minimum of $1,000. It has a profit target of 100%, and it also has a maximum loss of 100%, which means you wouldn't want to trade this with your full account size as you might with some of the other strategies we've discussed in the past. With this trade, you really need to keep the position size much smaller than those other trades. Now, let's take a look at the guidelines. The Super Bowl is a bullish vertical, and we enter it when the monthly cycle is 65 days to expiration. We enter the bullish vertical in a manner where the total profit, or the total potential profit, and a total loss are going to be about equal. Now, there are some small variations to that, but that's generally what we're going to do. And then from there, we do nothing until the next monthly cycle is 65 days to expiration. So if you pretend that May is 65 days to expiration, you enter the May expiration bull trade. As time goes by, eventually June gets 65 days to expiration. When that happens, you enter your June cycle. We will call that trade 2. The next thing we do at that same time is we check on the original trade, which we'll call trade 1. If trade 1 is up money, we exit the trade and take our profits. If trade 1 is down money, we monitor the trade once daily near the end of the day. If at that time trade 1 happens to be profitable, we exit. Otherwise, we just keep going until the trade expires. So let's take a look at an example. So right here, it is Wednesday, April 17th in our backtesting software. We have our June 2019 expiration. It is 65 days till expiration. Therefore, we come in and we enter a call vertical, which is going to give us almost $1,000 in potential profit, and it has a potential loss of just over $1,000, so just about 1-to-1. And that's it. That's the entry right there. Now, when we enter this trade in June expiration, we probably also have a May trade on. If we come in here and we take a look at our May position, this is what the May position looks like. So back about 30 days ago, May was 65 days to expiration. So I entered the bullish vertical just as I entered the one I showed you last time. And now 35 days later, this position is now up about 578 of our potential $1,000 profit. But because the other trade was entered, if this is profitable, we exit. So we exit this position, and then we go into our June trade, which is the entry that was just shown. So from here, what we do is we do nothing until it's time to enter the next trade, which is going to be sometime in the second, third, or fourth week of May. So if we go to the second week of May, we can see our July is still 72 days to expiration. That's 7 days. So 7 more days has to go by until we get our next entry point. So let me just do that. So we advance forward here to May 15th, and we find that on May 15th, our June trade is actually down. It's down $342. It is time now to enter our July trade. So I'm going to come in here and enter July. And I'm doing it in a manner where, in this case, my potential profit is a little over $800, and my potential loss is almost $1,200. Now, this is kind of unusual. Normally, we're going to get about a 1-to-1, and sometimes you can get a little over one profit. Sometimes you get, in other words, sometimes the profit's like $1,100, $1,200, and you can do a loss that's in the $800 range and be reasonably close to the market. And other times you can't. And this is one of those times where the volatility skew is very strange. So we're actually accepting a little bit less of a profit here, because when we enter this, we want about a 1-to-1 risk-reward ratio, but we also don't want our long strike much more than 10 points over the actual asset price at this time. And our asset price is at, let's see, 28.56, and our long strikes at 28.70. That's about 14 points. That's about as far as I'll go with that. Because once you start getting that any further than that, your probabilities start to drop off. So this is the way we would enter in this particular case. So what we're going to do now is we're going to look at our June position, and we're going to watch it from day to day, and we're waiting for the profit to just pop up profitable here, and we're just going to exit out of this particular position. And again, we're only checking that at our checkpoint time of the day. So if it shoots up during the middle of the day a little bit profitable, we're not going to take it. We're going to wait till the profit is there at the right time. So here, we're just going to advance, and we'll go to the 20th. We find the market came down further. We're now 32 days to expiration. Let's advance a few more days. And we would be just checking this every day. We'd just be coming in and saying, oh, look, no, the position's still down money. And therefore, we're just going to stay in the trade. So now we're down 462. And you can see the market's just continuing to go. So now we have a 35-point down move, and we're down 722. Let's just pop this forward several more days. All right, the market's just coming down here. Now we're almost at a total loss in the position, but we don't get out. We just stay in, and we wait this out because that is our acceptable loss in this. Right, so now the market's all the way down to 27.31. We wait. Now we're coming back a little bit here. We're starting to climb the hill. A little bit better. Friday the 14th. Here we are, 3 days to expiration. 2 days to expiration. We're still not profitable. And then we go the next day, and we get a nice pop-up right at the right time. It's expiration day, and we take the trade off for an $800 profit. And also during this time period, by the way, our August position actually surpassed an entry date. So let's go back to, say, the 12th, when August was 65 days to expiration. So at this point here, I have to take a look at my June trade. So we were trading along, watching our June trade. We were also in a July trade, which we didn't check at all until this date here, when this is 65 days to expiration. When that happens, I enter my August trade, and that's going to look like this. My June trade was down money, so it stays on. And I had a July trade on also. If I take out the adjustment, this was the actual position of the July trade when the August trade was entered. So I'm in my July trade. I go along. August hits 65 days to expiration. Oh, let's take a look at my trade. I look at my trade. It's up a little bit of money. We exit that trade, and that trade's essentially a break even. So we won on the May trade. We are down on the June trade. We broke even on the July trade. If we go to the end of the June trade, our June trade gets taken off at our $800 profit, and then our August trade looks like this until we get to the point where September is 65 days to expiration, and then we would take a look at our August trade and see if that was ready to come off. But either way, we'd enter our September trade, and we just repeat the process over and over and over again. So as you can see, even in a down or choppy market like we've had, and if you take a look at the price chart, we had a fairly hard down move here, and then we had our reversal. I mean, the trade ended up working out very, very well for that time period. Now let's take a look at the statistics of this trade, because some of you might be wondering, well, maybe you just hit a good time period. Well, let's take a look at that. Well, one of the things we can do in our O&E software is we can run reports, and if I do that, and I take a look at our Super Bowl historic statistics, just doing that process that we just mentioned from January 2011 expiration to today, we would have had 104 trades. We would have had a profit of $17,306. That's approximately 1,700% on our $1,000. We would have had an 86% win rate with 31 consecutive wins in a row and a maximum consecutive in a row of 3 trades. One of the challenges that I do tend to have with this trade is the loss, because when it loses, it's almost always a maximum loss, and when it wins, it's not always a full profit, is that your average loss is around $981, where your average win's only around $350. So our average win is only a third of our average loss. Well, first of all, that's not all that uncommon in some of the strategies, but that does create a risk in the strategy in itself. So that's just a caution sign. The other thing you need to think about is that the trade size has to be small in relation to your account size. I generally would recommend 1/10 the size or less. So in other words, if I was doing a normal bull trade, where if you saw one of the other winning trades where we do a bull trade, if I was doing a normal bull trade that had a maximum loss of $250 and a risk of $27,500, and I was going to do a Super Bowl instead of a regular bull, then I would do a total trade size of $2,500. In other words, I would match to my maximum loss and my potential gain. Okay, so this is a really powerful strategy. You can see it's done really well. If you'd like more information on the strategy or how it was developed, we're adding a bonus video in here. So I encourage you to check out that bonus video. It's an excerpt from our Trader Transformation Workshop in Orlando, where I talk about your maximum loss risk versus your structural risk, and we talk about different types of trades, and there's a lot of great information in there. So I highly encourage you to check that out. Okay, and that was the Super Bowl strategy, this episode's winning trade. And if you like what you see, I encourage you to join us and discover how you can follow along with this and other great strategies as they unfold during our weekly trade update webinars. You can also learn about upcoming winning trade presentations and stay up to date about the release of our new and exciting Trader Performance podcast, which is designed to help traders perform the best they absolutely can. If you have any questions or comments or anything you'd like to see on the next winning trade, we'd love to hear from you. Simply comment on this video below so we can get those questions answered for you. And we would also encourage you to come over to thewinningtrade.com, where you can find past episodes of The Winning Trade, as well as a lot of other fantastic information on how to profit through income trading. Thank you, and we'll see you on the next winning trade.